Our next guest is positioning for a soft landing and says the Fed has more to risk by being dovish. Right now, I want to bring in JPMorgan Asset Management's multi-asset portfolio manager, Phil Camporeale. Phil, let's just talk about the GDP number that we saw today and what that potentially signals. It was a stronger than expected, very strong 4.9%. Do you think things roll over, or this is part of your soft landing scenario? We come down from there, but we don't actually hit a recession.
Yeah, Becky, 5% GDP growth is not a soft landing. That's probably the opposite of a soft landing. But listen, the economy is defying gravity right now. And it's the gravity of this interest rate cycle that nobody saw coming. And if you look at the three things that matter most, Becky, we're talking about GDP right now. Yes, 4.9% this morning. That would be the strongest quarterly growth since December of 2021 after multiple quarters of above trend growth. The second thing is the labor market. Becky, that's the canary in the coal mine. I mean, that's really what matters the most here. And we're printing over the last 3 months, 266,000 jobs a month. There's 1.5 job openings to every one person that's unemployed. And Becky, as we saw this morning, initial jobless claims, which I think is the most important number, will not budge from about the 200,000 number. And then the last CPI number is the third thing, right? So it's GDP, it's labor, and it's inflation. And we just saw that super core number at 0.6. Now, that's why I believe that the Fed has more risk being dovish than hawkish, because they can't allow inflation to reaccelerate, and they have to keep talking tough. Now, as an asset allocator,
that doesn't mean other rate hikes, does it? Or you just think they stay higher for longer?
Yeah, that's a good question. So I think every meeting should be live. December is pricing in about 30% because, Becky, think about the backdrop I just went through. I mean, you have really a third quarter that's putting them in a position, we believe, to keep every meeting live and the options open. And there's two options. It's either high for longer or even higher for longer. Yeah. And they are going to push back any easing as fast as they can, and I think as far as they can, and I think that is what the market is dealing with over the past 2 months. I just want to be really clear about something, though.
Yeah, we're 20 seconds till the end of the show. But tell me what you do as an allocator.
Yeah, as an allocator, don't add duration just yet. 5% 10-year is not controversial. And we really like U.S. high yield. U.S. high yield is a no recession trade. Becky, a soft landing is no recession. It's also high for longer. And a high yield instrument yielding 9% is really attractive. And then don't get too far from home on equity, but we like high yield a little bit better right now.
All right, you like junk bonds. Hey, Phil, thank you very much for being on with us today. We appreciate it.
Less junky, Becky.
Less junky, at least in Phil's opinion. We appreciate it.